All startups that raise money have a cap table, which is essentially a mathematical list of all of your investors. And if you do raise money, you need to be sure that your cap table is not toxic, because the impact of a toxic cap table could be fatal for your business. Many founders unknowingly sabotage their startups by overcomplicating their cap tables. What seems like simple math can quickly turn into a mess after many funding rounds, leaving businesses with messed up terms, horrible investor preferences, and ultimately a cap table that gets in the way of growth. How can founders fix this even before this becomes a problem? At the Asia Tech Podcast, we want our founder listeners to know the answers to these questions. So we invited Bhavik Vashi from Carta to run us through some of the complexities of startup funding, the evolving landscape of venture capital in Asia, and how to avoid toxic cap tables. Let's bring in Bhavik now. Before we jump in, let's thank the sponsor of this episode, Dr. Tech. Dr. Tech can help you build your e-commerce store and start selling quickly online and on social media in just a few days. And Dr. Tech stores are gorgeous, modern, and responsive. They are fully customizable and simple to use. Dr. Tech stores have hundreds of included optimizations that will help you sell more online, and a support team that can answer all of your questions. With Dr. Tech, there are no hidden costs, no commissions on sales, no add-ons to buy. Everything is included in one simple subscription. So go to hellodr.tech/ATP to get a free trial and start building your store. You can find the link in the description below. Also, Dr. Tech is offering a special deal to the listeners of the Asia Tech Podcast. After your free trial, you can get your first full month for only $1. To get this deal, simply type ATP into the live chat and they will send you a special promo code. Thanks again to Dr. Tech for sponsoring, and now let's get back to the show. Your career, particularly your experience at Unapplied, kind of sets you up perfectly, right, to work at Carta, because, Carta was essentially formed, back in 2012, as just a way to help startup founders manage their cap tables, but to go through the whole process, to be fair, to help them get ready for acquisitions at some level, right? So they understood what their valuations were worth.
Yeah.
And all just how to keep track of it. I think a lot of people think that like a cap table is an easy thing to do.
Yeah.
But the math around it is actually more complex than most people think.
Yeah.
Anyway, I want to ask you this, though. When you're going through all these processes, right, how can founders, when you think about it based on your own experience and on Carter's experience, what you see there, how can founders avoid having like a toxic cap table, which can be really bad, right?
Yeah. You're right. I mean, cap tables, fundamentally, it's simple math, but it can get complicated really quickly. And I think that answers your question, which is a toxic cap table. I don't think I've ever heard it phrased exactly like that, but I think I get what you mean, which is you want to try to keep it as simple as possible, realistically. And so there are a lot of crazy things that you can do. And sometimes maybe out of desperation or necessity, you might have to. But thinking about the different kind of terms and preferences that you give different investors at different points in time, and how in isolation it may not necessarily feel that complicated to give a certain investor a liquidation preference or a participating right or something like that. But once you see how those start to compound when you do it multiple times, and then basically what we talk about, which is the waterfall, or effectively the math on who gets paid out in what order and how much, gets really, really potentially complicated across 5, 6, 8 fundraising rounds, and that's kind of what we see in the data now. Is eventually from incorporation to exit, you're likely to have at least 5 to 6 fundraising events. And so that you're going to go through a few rounds of that. And then so you want to try to keep that as simple as possible.
Yeah, I mean, in my experience, and I've invested in a bunch of startups as well, but I was also a limited partner in a venture capital company, right? Yeah. So fair enough. I've seen a lot. Part of where the toxicity comes from, I just want to go back to this for a second, is something like these liquidity preferences. But like, how can founders tell the difference between what a great investor is going to be like and what a bad one's going to be like? Like, what do they need to look out for?
Yeah, my point of view on this is actually like relatively simple. I think it's not that dissimilar to how you would approach dating, or how you would approach,
I like it.
Making friends. Like, ultimately, there's a judgment call, and the judgment that you're making is on the character of the investor. Obviously the strategic alignment in terms of their interest, experience, network, and what you're trying to achieve. And, I guess the underlying context is, are you operating from a place of abundance or scarcity? Like, are you, do you have a line of investors that want to get in, or are you kind of, you just got the one, and now you got to make a decision of, do you want their money or not? So you can't really give blanket advice, right? Like beggars can't be choosers, but assuming that, you have a company and you have some interest, it's really a judgment call based on kind of what you're looking for from an investor. There's no math to it. I think it's a lot more on the soft and qualitative side.
I could not agree with you more. Did you work in Silicon Valley? You went to school in California, right?
Yeah, I went to UC Berkeley. So yeah, very much indoctrinated into the world of entrepreneurship and progressive thought. And then I worked in the Bay Area.
So I'm just so curious, right? Like I've never worked in Silicon Valley.
Yeah.
I worked in New York for a long time. Well, not for a long time, but I worked on Wall Street for a long time, right?
Yeah.
But after living and working in the Bay Area, can you talk about some of the differences between there and Southeast Asia? Look, Singapore always ranks really highly on sort of the global scale of like where great startups get built. Yeah. So fair enough. And I've been to Singapore 1,000 times, right? Yeah. But can you talk about some of the differences and maybe what we can learn from what happens in Silicon Valley and what we can actually legitimately import into Singapore?
Yeah. I mean, probably the most obvious difference is everybody there is in a Patagonia vest. And that doesn't make a ton of sense here in Singapore. Not really. Albeit I'm in a sweater at the moment. So, but jokes aside, I think, it's an interesting question. Obviously, a few things. One is, again, as simple as it may sound, there's a culture in Silicon Valley, that culture doesn't quite exist yet in Singapore. I mean, I think it does in pockets, and it's certainly progressed a lot in the last decade that I've been seeing it. But in Silicon Valley, it's a way of life. Entrepreneurship, innovation, startups, it's a way of life, and it's what some of the brightest minds. I think it really starts here is the brightest minds that are entering the workforce from universities. Yeah. Have kind of grown up in that world of research and innovation, and then how do you privatize and capitalize on that innovation, whether you're from Stanford, Berkeley, or any of the other kind of schools in the area. Whereas in Singapore, traditionally, you're still kind of looking at like major companies getting a kind of a good, secure job there, or maybe you're looking at like an MNC tech company. Obviously, right. Facebooks and Amazons are big employers in Singapore, Google, right? And so startup that you don't normally see like number 1, number 2, number 3, number 4 students necessarily saying my dream is to either join a startup or to create a startup. And again, I'm not saying that those kids are even necessarily the best suited to be a startup founder. I think there's actually a lot to be said about the grittiness and resilience and some of those other characteristics that are really core and necessary, which I think people who have failed a little bit more in life up to that point tend to have, again, just as a trend. But that would be the main difference. And then as a kind of a downstream impact of that, there's a bunch of other differences, which is maturity of the ecosystem in terms of just the venture capital ecosystem, the depth of VC and private equity money available, which then makes it easier to obviously try your hand at entrepreneurship. The increased, likelihood of exits, which motivates people to kind of go on that journey, both ultimate exits, but also like substage exits, and then kind of just the environment in terms of the network as well. They're all like kind of self-fulfilling prophecies of the network of people that you end up operating within, and the networks you end up creating. They'll just almost always find a way to lead you back into the startup world or the VC world if you're in the Silicon Valley.
Yeah, I mean, interestingly, I've seen a lot of really great founders from here actually go to Silicon Valley and try to just like suck up the culture. And it's weird, right? Because you can, and I love Singapore. I do a ton of business there. It's nothing against it, right? But when you're walking around or sitting in a coffee shop, finding the other guy or gal that's building something from scratch is not really straightforward. But I feel like in Silicon Valley, you could literally like wake up, go downstairs and grab a cup of coffee and run into 16 other founders. Yeah.
Yeah, that's right. I mean, you walk into a Phil's Coffee, right, in San Francisco, right. You're going to see at least 15 people operating on MacBooks and just deep in the zone, which is always funny to me because I could never work at a coffee shop personally, but me either. But they do it and it works, and you can see them ideating and really getting into it. And then that's, you touched on an element of the culture there. There's a profound, I think, openness in Silicon Valley, especially the early stage, where sharing of ideas, sharing of what we call IP, it's pretty free. Like they believe in open sourcing. They created that concept of open sourcing, right? And so that's also a little bit different. Although again, like I said, I can see a lot of attempts being made to create and foster that culture here in Singapore.
So you bring up a really interesting topic for me. What's your view on having a stealth startup? Because you said there's a culture of openness and sharing, right? And I'll tell you my philosophy. So you don't have to think it. You don't have to worry about like what I think about this. I think it's ridiculous. Like if you're a great founder, you're going to tell everybody exactly what you're doing because you're not afraid to be out executed. Is that fair?
Yeah, I broadly yes. As ever, there's always a case to be made. There's a reason. If you're going into an industry that has some pretty established incumbents and know the competitive landscape super well, and maybe your idea came from consulting in that industry for 10, 15 years and all blah, blah, blah. Okay, fine, I get it. You want to go stealth because you know exactly who you eventually want to either fundraise from or sell to or all of that. But broadly, I would agree with you. I think that there is a lot of validation and a lot of iteration that needs to happen very, very early in a startup's journey. And you can't do that if you don't tell anyone else what you're thinking about working on, right?
Exactly.
So I think people over-index on that secrecy and thinking that that's going to be the competitive advantage. That's not the competitive advantage. It's what you said. It's execution is everything, and product market fit. So really, like product market fit and then execution, and you've got two things to worry about.
Yeah. Look, I think hopefully you understand this reference. I went to summer camp when I was a kid.
Yeah.
And you'd always get these kids go home from summer camp and they would say like, oh, I had this killer girlfriend when I was there. She was amazing. They're like, when do we get to meet her? And the answer was always, she's in Canada.
Yeah.
And I feel like the stealth startup is the same answer. I'm building this amazing company. Where is it? She's in Canada. That's just what it feels like to me. Anyway.
Yeah.
So what brought you to Asia? Where are you originally from, by the way?
I'm American. I hold a U.S. passport. Where am I from is always a complicated question for me because
where did you grow up? It's a bad question because it's the same thing for me. I get it. I hate people ask me this. Rephrase that.
Yeah, I'm of Indian origin, born and raised in the U.S., holding a U.S. passport, living in Singapore for 8.5 years now. I grew up across the U.S. A real answer. So I lived in 8 different states between being born and middle school, basically.
Oh God, I did similar.
Yeah.
Lots of fun.
Yeah, a lot of fun. Didn't know any different, right, at that age. So to me, that was just normal. I only realized that was not normal later. And so that was fun. So both the kind of the southeast of the U.S., the Midwest, and then ultimately I found myself in California, Southern California, which was a great place. So middle school and high school in Southern California, Orange County, and then college at UC Berkeley, and then started my career in Silicon Valley, as you mentioned, and then Singapore.
So listen to this: California, Massachusetts, Connecticut, New Jersey, Pennsylvania.
Yeah.
That's all before I graduated from high school.
Nice.
The longest I've ever lived in my whole life is Tokyo, and I'm for sure not Japanese.
Yeah.
So it's strange. It's just a strange thing, right? So when people ask me where I'm from, I'm just like, I don't know. What's your favorite team? Because I probably lived there.
Yeah. It's a truly global citizen, and I don't know where I'm going to be either, right?
Exactly.
My family's all over the place as well. We've got family in all parts of the U.S. and India and Europe and stuff. So yeah, it is always a tricky one for me.
So what made you come to Singapore? What made you want to be in APAC?
So I'll be honest, I had no desires as such to end up in Asia Pacific. This was very random.
Really?
Yeah, it was. I was minding my own business. Being reasonably successful at a growing startup called Anaplan. I think I was in year 3 of my employment there, and in that time we'd already done a couple rounds, and team had like tripled or something crazy. Like we were going through that really fun stage of growth. Yeah. And I was building out a team in the Bay Area and across the West Coast, where all our large customers are. In short, one of our founders actually just kind of came to me with this crazy idea, which was, why don't you move to Singapore and kind of help us build our Asia Pacific business? There were a lot of reasons, specific reasons why he wanted to do that in terms of the timing of it, the opportunity. But at a high level, it was just like, hey, this ship is sailing. This thing is going to keep working, whether you're here or not in the U.S.
Right.
But we think you're great, and I think you'll make a big difference if you go to Asia Pac. Because Asia Pac, I don't know if it's going to work or not, but I feel better that it'll work if I send you out there. I think you can have a bigger impact there. And that usually is a good sales pitch to me. If you're kind of convincing me I can be important somewhere or have impact somewhere, I'll probably lean towards saying yes. So I did.
Yeah. My boss came over to me on a Tuesday afternoon, okay? And when I was at Goldman Sachs, we had a small business in Hong Kong that he wanted to make bigger. I was living in Tokyo. He literally tapped me on the shoulder and said, "Would you consider going to Hong Kong?"
Yeah.
I was like, "Sure." Because he needed it. It was kind of the same. He said, "We need somebody to go there and fix that business. It's a mess." And I was like, "I'm already packed."
That's nice.
And that's exactly what I said. I said, "I'm already packed." So I think I had your writer actually working for me at the time.
It's amazing. Yeah, mine was really funny. Mine was I had a rambling voicemail from one of my founders, which had never happened before. I don't think I had a single voicemail from him prior to that voicemail.
Oh, wow.
And I got it on a Sunday. I'm like, this is weird. Like, he never calls on a Sunday, never leaves a voicemail. And we ended up going to dinner that Wednesday, I believe, just the two of us. And he kind of walked me through the whole thought. And then I think it was that following Sunday, we were flying to Singapore. And I had never even been to Singapore. I had literally never been in this country before. And I had kind of in principle agreed to relocate here already.
So that's why I told you this story. He came over on Tuesday and I said, "I'm already packed." He literally came to me on Thursday and said, "You're leaving tomorrow."
Wow. Yeah.
He didn't come with me, by the way.
Oh, yeah. Wow. That's, no, my founder came with me. He was very nice. We did it together.
I love it. I love it. I love it. I mean, obviously it's been good for you, right?
It's been great. It's honestly been life-changing in the genuine definition of that term. Like, completely redirected the course of my life. I mean, I'm still living here. I'm a permanent resident here. I met my wife here. I had my kids here. Just totally changed everything.
So what made you switch companies? Like, why did you decide to join Carta?
Yeah, I mean, I think I was very happy at Anaplan. It was such an amazing company, and pretty much ran it, not to its end. It's obviously still operating as a private company now, a private equity-owned company. But when I was coming into kind of year 10 at the company, naturally I had done well and kind of risen the ranks and all of that. So there was kind of a bit of a ceiling, right, in terms of where I could grow within the company had just gotten much larger. Now we had new PE owners. And so there was that reality of kind of knowing that I might be tapping on the ceiling of my potential there. And then the second is the acquisition. Frankly, it was an all cash acquisition, and they accelerated some of our vesting as well. So for the first time in basically 10 years, I had no financial carrot angled over me to continue to stay. And so it really forced me to think about, and so like, I need to have like a first principles exercise here of, do I stay or do I go, pros and cons. And as many of you who've kind of been through like a career switch, like once you start thinking about that and then you start having conversations and then you start seeing what's out there. And I spoke to like some 30 companies before I settled on Carta, and then you're kind of in it. And luckily for me, there were lots of interesting, great opportunities. Carta was one of those, the one that I thought was best. And so, I made the leap.
Yeah. I mean, look, you started this whole conversation with a dating analogy. So I'm going to say the same thing. Once you consider breaking up with somebody, you've already broken up with them.
Yeah, it's tough. Although I will say, contrary, like there were at least 3 probably real times where I thought about breaking up with Anaplan and I didn't. And each time, the decision to stay was definitely the best decision in retrospect, if I evaluate the alternatives or kind of project what those might have looked like for me. So definitely had been through an exercise like that before, but this time it just made a lot of sense to leave. And part of that was the pull factor from Carta. As you said, I got recruited by the CEO and founder, Henry Ward. I work for him directly. That's a large part of it. I think he's an incredibly charismatic and super dynamic individual. And then, just the opportunity, the stage, the company, the ethos of it, which, as you said, kind of resonated super loudly with me. So,
Was there a mind? I really want to talk about this acquisition because I've never been through one, right?
Yeah.
And if you're at a senior level, whether you're at the home office or whether you're in Singapore, right? Is there a mindset change among the people that have an equity stake in the company when you realize that there's going to be an all cash acquisition? It's because it's meaningful to your life, right? For everybody that's involved. Yeah.
Totally.
What is that feeling like? What's that experience like?
It's a complicated emotional experience. I will say. So, for example, I mean, I'll just share about mine and then maybe I can talk at like what I think other people went through because we all talked about it naturally. But for me, like I said, Anaplan felt like my family. I mean, it was there for 10 years, grew up there. And there was, I don't, still to this day, I don't think I have a professional accomplishment that I feel more proud about than standing on the floor of the New York Stock Exchange on, I think it was October 12th, 2018, and waiting for the first trade of our stock PLAN plan to execute, and just ringing the bell when it did, and being there with our founders and a group of maybe 50 of us that were invited. And it was truly special and unforgettable. Yeah. And so having, we had seen the high of that, I would say. And then I'd operated the company as a public company for about 4 years. And so you think the sky is the limit, right? You think you can go compete with Salesforce now. Like you can go compete with the Workdays of the world. At least those are some of the bigger B2B names that we were going for. And then you get this news, even in your senior leadership, you generally aren't read into the fact that you're going to get acquired. That's very tight. And so you get the news just like everybody else does pretty much, which is maybe you get a couple hours or a day before, which is, hey, we've entered into a definitive agreement to be acquired by this firm for this price. And it's kind of shock because on one hand, it feels like, oh no, somebody is taking us over. Our company as we know it ceases to exist, right? Like there is a feeling of that. And then on the flip side, you're like, oh my God, this is financially amazing. Like this is crazy. This is putting more money in my pocket than I would have ever dreamed of. And it's happening all at once versus as a public company, every quarter you're like, all right, what's going to happen on the stock? Am I going to sell? Am I going to hold? It's like an investment that you're constantly monitoring versus this is like, you don't have a choice. We're just we're buying everything off of you at this price. It's all yours. It's in your bank account. Yeah,
particularly from a private equity company, right? They're not leaving other stock out there. They want to own the whole thing because they think it's wildly undervalued. They think they can create more value for it and then at some point sell it back out to the market at, who knows, double or triple the price, right?
Exactly. And that's the next thing that comes in. So it's like the shock of like, oh my gosh, my company's being bought over and how do I feel about this? And generally PE has a bad reputation from an employee perspective, because you're like, oh, they're going to cut costs, they're going to change the culture. These are the general fears that employees have, and I wouldn't say they're completely invalid. Then it's the, oh my gosh, this is an amazing payday, step 2. And then step 3 is like, what does this mean for me, right? And part of what it means for you usually is like, how do I fit in to the PE firm's thesis about the company? Like, why did they buy this?
Do I want to?
Yeah. Right, exactly. And they paid a premium to your public price. Why? Why do they think they can flip it in 5-6 years for a gain? Like what does that underwriting process look like for them? And then how does that jive with what you want to be doing for the next 5 to 6 years? Because that's their time horizon, right? And so you know that you kind of are looking at another extension of 5-6 years if you really want to see it all the way through. Because anyways, I mean, not to get too much into it, that's basically what they're doing.
Fascinating.
They're accelerating your vesting so that they're telling you, like, if you want to go, now is the time. Because we're going to flip all your equity holdings into these profit interest units and these other ownership structures, but those are going to tie you in for another 5 to 6 years, the same time horizon that they look at the company if you're in leadership. So yeah.
And you're going to lose some agency as well, right? Because when it's your company, you have the agency, but once they take it over and switch the structure of your equity holdings, you're going to lose a lot of agency. So the decision kind of gets made for you at some level. Yeah.
Yeah. That's right. You have to be in the boat. Like that's your decision point of like, am I in the boat? Do I think their investment thesis makes sense? Do I think that they can return capital on their investment? And do I want to participate as a hardcore operator and executor of their strategy over the next 5 to 6 years because I either agree with it or I think it will work and I want to, participate in the gains as well, or simply something else like maybe, things are good in life and you're looking to, maybe not take the foot off the gas or something like that and focus on other things. Like there are a number of reasons why people I know have stayed, but for me, that math and equation didn't make sense.
Yeah. I mean, I don't know you well enough to say this, but everybody has their own sort of idiosyncratic personality. Yeah. It doesn't seem to me like you're the kind of guy that wants to work at that company. Again, nothing against Anaplan or private equity. It's just that you seem like somebody who wants to have a ton of agency. And that's a compliment coming from me. So fair enough. So now that you're at Carta, now that you're staying in Singapore, you've built a family and stuff like that. Like, how's growth going?
Yeah,
right. What's the goal, right? Because clearly in the United States they dominate this space, right? What's the goal out here? How's it going?
Yeah, no, it's so Short answer is it's going really well,
Good.
which is exciting. Because
Yeah.
I mean, after spending 10 years at a company, like you always have that moment of doubt of, am I going to find another company that I like as much, that I can thrive in as much, and B, like, am I going to be good at this? Like, am I good at this, or was that a one-hit wonder type of thing?
Right,
there's
right.
always a moment of self-doubt for anyone. They're lying if they say they don't have that. 2 years in, I'd like to think there's been an extreme level of validation for what we're doing here. And I think mainly the exciting thing is that we're kind of transforming the business. Like you said, most people know Carta as this cap table and ESOP management company. We're actually becoming like an operating system for private financial markets. And what I mean by that is, if you think about the cap table, we're solving a problem for the founder fundamentally, which is the ownership structure of his company or her company. But one of the biggest beneficiaries of our products are investors, right? Because the investors now log into a single platform, Carta, and they can see 20 rows of 20 different companies they've invested in. And they can basically just click into each of those rows to see the underlying holdings in that company, the digital stock certificates and what percentage of the company they own and what it's worth today. Before, they'd be getting 20 different paper stock certificates, 20 different emails from different founders and stitching it together in some Excel something.
Spreadsheet.
Exactly. Yeah. And so investors love Carta, and they would start recommending companies to use Carta for their own benefit. And what we realize is actually investors have the exact same problem set at a very high level that founders have, which is they raise money from investors as well, called LPs, and they then have to allocate that money to underlying assets, which are the companies on cap tables from Carta, and then they've got to do the same thing,
but in reverse. Yeah,
exactly. And so there's a lot of Excel, a lot of email, a lot of PDFs, a lot of math, but math that is kind of simple but gets really complex once you do complex legal structuring and side letters.
It's simple until it's not.
Exactly. Basically. So very similar concept where the truth lies in legal documents. And then you have to kind of translate that into a ledger of some sort. So we were like, we can do that. Yeah, sorry, guys.
Are you trying to standardize? Because here's the thing.
Yeah.
Every company that uses Carta, right, as a startup company, gets the same look and feel, essentially.
That's right.
On their cap table.
That's right.
And yet on the flip side, every venture capital company probably just has an intern from Berkeley, to be fair, right, or from Harvard, creating a bespoke spreadsheet. I'm sure it's an Excel spreadsheet or some Google sheet, right? And they're all different. So when you compare them to each other, there's no way to really compare them. So on the flip side, if they all log into Carta, again, now they're getting a different view on the same data because their shareholdings don't match any other VC shareholdings. But it's now easier for everyone to see it. You can see it in Singapore. You can see it in Tokyo. You can see it on Mars if you have an internet connection. And it always looks the same everywhere in the world to all of the people that are involved in your company. And then, to be fair, like if you're an intern or a low-level person at like Anderson Horowitz and you move over to like Benchmark, you're just looking at a completely different system. Unless they're on Carta, and then it's going to look exactly the same to them. So it just makes everyone's life easier, no?
That's right. There's a tremendous opportunity for standardization, and there's also, it plays really well with globalization of capital. Because when you move upstream, there are very few large asset allocators who are concentrated in a single country or a single stage of growth. They're spreading their bets across the private markets, and so. Yeah, it makes sense to see things in a more standard light. And the other big thing that we have going for us, which is accounting, right? Like the core of a fund is fund accounting. It's your NAV, it's your IR. It actually should not be done 10 different ways. It actually should be done the same way, whether it's US GAAP or IFRS. And so by standardizing the core accounting, which therefore means it can be automated with software, and then giving you the configurability of presenting your reports in a different way, perhaps, or branding your LP relations in a different way, those kinds of things. But the core accounting and also the core workflows, whether it's a capital call, an investment, a distribution, those should all more or less function the same. And so, yeah, we're really solving that problem. We call it kind of Carta fund financials or fund administration for private market funds like VC, PE, private credit, et cetera. So that's kind of the new opportunity, or kind of the next wave of opportunity for us as we expand our nodes. And that's what I'm spending a lot of my time building in Asia Pac. Like we have the startup product. A lot of startups use us. Like you said, it's kind of table stakes, but where we're actively thinking about is how do I solve for this huge private capital ecosystem emerging in Singapore, emerging in Middle East as well, which is why it's part of my remit. Like these two markets are super interesting right now.
So 10 years ago, and even maybe up to 5 years ago, I would say once a week or twice a month, you'd see like a new VC fund pop up. You just would. Like it was just all the time.
That's right.
Some guy that used to work at some other company was like, I can do this on my own. And my father knows this lady who has $1 billion and she'll give me $10 million, right? So they were popping up all over the place.
Yeah.
You don't see it that often anymore, actually, out here, right?
Yeah.
There aren't a lot of new funds being formed. And to be fair, a lot of the smaller funds, because they're smaller funds, and frankly, there's no way to pay yourself if you just have a $10 million fund, like you have to eat, and there's no money left for food there.
Yeah.
But family offices are a growing influence, not just in this region, but all over the world, and definitely in the Middle East. Are you seeing that as a potential Carta client as well?
Short answer is yes. I think of family offices primarily as LPs, although I understand that in a way you could consider them a fund in their own right. But I think the way that most of the family offices we engage with, because there's a need to diversify on behalf of the family, usually they operate a little bit more like an LP, an endowment, a pension, et cetera. We're more they kind of got those wealth management principles. And if you think about the LPs, they are very similar to the investors looking at Carta cap tables 5 years ago, right? So that relationship between GP and LP is very similar to founder and investor. And so right now, if you think about, and I'm just going to spend a second on this, the person who pays Carta money is the GP or the fund manager. The beneficiary, you could argue one of the biggest beneficiaries of the product is the LP. And so in that light, family offices are actually one of the biggest beneficiaries of Carta becoming a preeminent fund administrator in this part of the world, because now they get A, consistency, B, transparency, and C, visibility. And that's, I think, really, really powerful for them. And so we're thinking about, we recently put out, for example, a VC fund benchmarking report. That's the kind of stuff that family offices and LPs had a lot of trouble getting to. And so, but just as a result of our market penetration, we have almost 2,000 what we call emerging fund managers, a lot of those first-time fund managers that use Carta because it makes sense for them. And now we understand what the median IRR looks like. What does 75th percentile look like? What does 25th percentile look like?
So you have all this data.
Yeah, exactly. And family offices and LPs at large love that, because then that helps them make better investment decisions on behalf of their families. And so that's where we're starting to engage that community a lot more.
Yeah, I was thinking more to the extent of, if they give money to more than one fund manager, they're going to want to do the same sort of financial fund management that the GPs are doing, but just again from a different lens, because their holdings per se are just a group of other funds, whereas the funds, their group of holdings are companies, and the company's holdings are just the shares, right? So it all kind of melds together. That's what I was thinking about.
Precisely. And that's why, I think the benchmarking, the data, the insights is kind of our first step in engaging or warming up that audience. The second or third step, just like we did for investors, eventually we built them a product that we sold to them directly. I think it's not super provocative to say we will build a product for LPs and sell it to them at some point.
I've got another question, kind of related, right? Why do you think investors develop specific theses, right? Because you must see this across the board, right? Yeah. They're like, I know that everybody looks at the world in a completely different way, right? Mm-hmm. I have this conversation with my friends all the time. That guy walking down the street, he may bump into you because he literally didn't see you, right? So I get the fact that people look at the world in different ways, but how do you think they develop these theses to so specific?
Yeah, it's I've seen broadly two categories, and then you could break one into more categories. First category, simple one, based on their experience. It's very straightforward, but their life.
Right. I worked at a chemical company. I'm into biochemistry. I got it. I'm going to be a biochemistry investor. Totally. And then you're doing something unique and niche that's interesting to investors who want exposure in that area. They trust you to know it better than anyone else, and so you're differentiated from every other early stage fintech fund, just to use an example, right? The second category is actually, it's almost reverse. It's not so much that they have conviction about a specific thesis or category, but they are
seen as, usually experienced asset allocators and kind of custodians of capital. And then they actually get approached, or they have a relationship with a specific LP who wants them to go
to do that,
do something specific in healthcare in a specific country, or deep tech, cyber, and like they have a reason. And sometimes those reasons are because they're coming from an asset allocator are strategic in nature. Sometimes they're mission driven and philanthropic in nature. And ultimately as a GP, it's like, okay, this is intellectual exercise for me. It's like someone told me I have to go deploy 50 million in capital doing consumer healthcare in India. That's interesting. Like, how now? Let me go work on that problem for the next 3 years of deployment, and then I'll harvest it. So broadly, I see these two categories.
Yeah, I was just thinking the same thing. I was looking up, like, so if the Bansal brothers came to you and said, we'll give you $100 million to invest in pharma tech in India, you're just going to have a fund that invests in pharma tech in India.
Exactly. And they don't have the time. They'll pay you to do it. They think you're really smart. They think you'll figure it out.
Well, and they're in the midst of the market, and they see all their friends investing and inventing all this great stuff. And they're like, just do this for us. We'll pay you the fees. It doesn't matter, because we think it's going to go from $100 million to $10 billion. Do you see different usage or product needs in different regions? Do you know what I mean? So you're in Southeast Asia, let's say, and then the team in Silicon Valley. And does that change the product development in Carta? Right? Because it's not a fixed product, right?
That's right. Yeah, totally. And I think specifically for both of our, if I oversimplify, let's say we have two product lines, one that serves founders, one that serves investors. For both, the work that we do is really either adjacent or absolutely integrated with regulation, so law and tax, right? And because of that, it's different in every single country. And so by definition, and so yes, that's the main area of divergence, I would say. If you had to find one, is like accounting is pretty standard, and GAAP and IFRS are not that different. And so you can actually build a platform that does, the core accounting stuff. Reporting needs are different, but you can usually build a reporting capability that gives enough configuration back in the hands of the user or the power user to let them kind of report the way they need to. Other concepts like portfolio monitoring are, again, pretty similar. Like, I need data on my underlying investments, business metrics, et cetera. I've got to collect them, analyze them, and then model the fund based on it. The things that are really different are tax, and all the different incentive programs and things that exist in different countries around tax benefits that most investors need to avail. So you've got different legal jurisdictions, different tax incentives, et cetera. And then obviously the law itself in various different jurisdictions, which you need to basically encode into the documentation that drives the rules or definitions of your fund. And those are the two areas that we customize, or kind of the most regionally. Like, each of our regional MDs has engineering and product dedicated to us to make sure we're solving our key markets.
Your local problems, right?
Yeah.
Look, I'm so attuned to trading and changing valuations with real-time data because I did that as a job for years, right? I mean, I sat on a portfolio trading desk, so many stocks across multiple markets, and that's just kind of the way I think about things.
Yeah.
Private companies don't work that way, but I do get the sense that a lot of the founders are providing, I don't know, maybe monthly or quarterly reports to their LPs, right?
Quarterly.
So they're quarterly, right, to their investors. And I know that, or at least I believe, right, that private companies don't change their valuation for the most part unless something trades.
Yeah.
Right? So unless some stock trade changes hands, you don't really know. But the reports that they get are a good indication. Is there any way to build a product so founders can get a sense, but also so the investors can get a sense of where that thing should be trading based on either the growth or the falling growth of that company, if you know what I mean? And since they're publishing them anyway, is there any way they could submit them to you? You collate that data for that particular company, you track it, you build that kind of type of stuff, and you go, it was $1 billion before, but now it's probably 1.25 kind of thing, just based on growth?
Short answer again, yes. A lot of people don't realize this because it's kind of grouped in with our other stuff. Carta is the largest valuations provider for startup companies globally. Because, like you said, we have the data, And so it's kind of a chicken and egg. The more valuations that do, the better we are at them. So we can start giving you comps. If you're cyber in this country, we know what the comps look like, not just the public comps, which everybody has access to and you can
but the private
do,
comps.
but the private comps as well, right? And then similarly, we are now slowly becoming the leading valuations provider for funds as well. So in the U.S., it's governed by a different it's ASC 718, I think. In international markets, fundamentally, both companies and funds are valued under IFRS 13. But as you know, fund managers will take the most aggressive, generally speaking, valuation on their portfolio company, and the portfolio company wants to take the most conservative.
Right.
And so you've got a range on both of those.
Yeah.
And so we provide valuation services to both, exactly for the reason that you mentioned, because I think we're in the best position to answer that question.
So again, just a random idea for me, but is there a way, again, because you have all this data, they must trust you with this data. I'm sure it's, behind some kind of massive firewall with a bunch of guys with guns and stuff, but
that's exactly what our security strategy is, by the way.
It should be, particularly in the United States. But because you have all this data and you're intimately aware of the company's growth trajectory and all this other stuff, but from a very early stage, right? So you're working closely with the founders, you're working closely with the investors. I mean, I know it's kind of crazy, but like, shouldn't you have an IPO team? Hire like 4 guys from Morgan Stanley, hire 3 guys from Goldman Sachs, hire 2 guys from whatever else still exists, and just go, your job now, because you know how to do this, is to take these companies public as a service. Do you know what I mean?
Yeah. I do know what you mean. And I will share with you that at one point in our history, we had a pretty large BU, as we call it, business unit focused on public. Exactly to your point, like, how do we take companies public? How do we continue to be?
How do you prep them to go public?
How do we prep them to go public? How do we roadshow them? How do we obviously act as their brokerage firm once they are public? How do we then get into the wealth management aspect of the brokerage accounts we get through employees? It's the classic playbook from Morgan Stanley and Goldman and others, JP. So we had that short summary. It's super hard.
It is. That's why they get paid the big bucks.
It's super hard. And our core competency that we've kind of concluded is like building B2B software, not becoming like a full-fledged financial services player. Although that was, like I said, definitely a fork in the road for the company. And at one point we could have gone down the hardcore kind of fintech, finserv route. We've decided probably what's most strategically relevant or valuable to our shareholders and us as a company, where we think we're most differentiated, is continuing to build out as a B2B SaaS player for a very lucrative and underserved niche vertical market, which is private capital. Because most software companies build for big companies, basically. If you're a B2B software founder today, most of your VCs will tell you like, find product market fit with some SMB companies, but then you have to go mid-market, then you have to go enterprise. Like, go sell your software to Walmart, go sell your software to Coca-Cola. If you do that, we love you. We think you're amazing. So what we're doing is pretty counterintuitive, which is like, hey, we're selling software to startups who are super, investors call low quality revenue streams. And then we're selling software to fund managers who have very small operating teams, generally speaking, and budgets. And then potentially we'll be selling software to LPs who definitely have deep pockets, but like almost non-existent in terms of headcount. So it's a contrarian view, but we have a lot of conviction around it.
Yeah, and look, I would say this: even if your budget's not that big, everybody needs a desk to sit at and a computer to work on. They're still paying for that stuff too. And if you want to run your business either as a founder or as a VC fund without knowing like what the valuations are of the companies in which you're investing, go for it. One last thing before I let you, I want to say this first though. I feel like we've left a lot of stuff on the table.
Yeah.
Anyway, we can discuss whether you come back or not. That'll be up to you, but I'd love to have you back because there's so many other things I'm sure that you've learned over time. But before I let you go, what kind of advice would you give to founders, growing founders?
Yeah, I get asked this question a lot, and I have a ton of respect for founders.
It's hard.
In fact, I would say I'm borderline like envious of them, not because I think their quality of life is great. It's not. It's more the the risk appetite that they have is truly impressive. And then also the resilience. There's a reason I'm not a founder, for example. I love operating companies 0 to 1, 1 to 10, 10 to 100. But being a founder is a whole different thing. All that being said, my advice to founders is make sure that you surround yourself with people you trust. I know this is this has nothing to do with business, but I think it has everything to do with business. The number one area where I see founders struggling is kind of not having the right support system and professional network around them to help them to be successful. Because it always takes a village, right? And the founder, your job is to have a lot of conviction and to lead with a vision and a mission and a vision, and have clarity on kind of where you want to take things. But you need to surround yourself with people that are going to help you execute against that. I think it's really, really hard to try to do kind of everything, and then finding the first, your co-founders and your founding team, finding your first 10 employees, finding the right first couple investors. I really feel like that's make or break. Startups pivot all the time. I've invested in companies and I thought I was investing in one thing, and 2 years later they're doing completely something else. And that's just the nature of it. So it's almost like the idea and the product market fit and strategy and all this stuff doesn't matter that much. What matters most is the people involved, and that's you yourself as a founder. But I'm not going to give advice to a founder, be like, go check yourself. So my next advice is surround yourself with the right people, basically. And those people look different based on who you are. Right. Yeah. So the people I surround myself will be different than the people, Michael, you surround yourself with. And that has a lot to do with, as you said, the idiosyncratic nature of us. And so, I can't get more specific, but just have a good idea of who you are and what works for you, and then surround yourself with people that bring out the best in you.
Perfect. Bhavik Vashi, a managing director for Asia Pacific and the Middle East at Carta. This was awesome. I hope you enjoyed this as much as I did. Thank you so much for doing this.
Yeah, it was super fun. Thanks for having me.